Good. Gee, it's good to have you here on a Sunday evening where I am. This is Geoff Pine coming to you live from Tasmania in Australia, where it is bucketing down outside, I've got to say. And if you've got dogs, you'd need double chains on at the moment because the wind is whistling like no tomorrow. And good old Australian whistler that recalled what his name, can't forget his name. I can't remember his name. And it just won't come to mind. But that's what it's like here at the moment. Absolutely whistling through the trees. And if they're still standing tomorrow, that would be an amazing thing. Thank God the bamboo will be. Look, we've got an action-packed show coming up as always, and I can hear some laughter in the background, and I know that that's coming from New Zealand, where we're going to be joining Julian very, very shortly. We're also going, and Julian will be looking at all things big picture, the macro world of the markets, and that's always a wonderful insight into what we can expect coming up in the week ahead. We'll then be joined by Alexis, who will, of course, take us through the fundamentals of what's shaping the market up at the moment, what's current, what's not, what we can look forward to in the week ahead as well. Ash looks at all the numbers. He's the numbers guy that we've got. And that, of course, comes to us from the UK. It's a truly international show today, without question. He'll be looking at the numbers, the data releases that are coming up potentially, but certainly what the commitment of traders is all about, as well as seasonal biases. We'll then be joined by Ainslie, coming back to Australia, back to my neck of the woods. She's been in lockdown for 50 days now, I believe. And I'm sure there's a few hairs being removed from her head. I can hear her chatting in the background. She'll be looking at that precious metal, of course. We call her the golden girl. She loves to trade gold, and she'll be looking at that very, very closely. And back a little bit later with that black gold oil. She'll be looking at that one as well. Then we go to Malaysia, where we will talk to, well, I suppose the hottest topic around at the moment is the crypto world and how that's shaping up. I think I was speaking to Shukri earlier, and he just says crypto summer. I'll see how he's going to deal with that. As I say, that's the hottest topic around at the moment. Then we're going to the US, and we're going to have a look at the stock markets with Gordon. And he's got. I looked at the recording. He was coming to us recording today because he's probably sound asleep, I should imagine. And I was having a look at his recording early. Very, very interesting to see his take on why we're seeing higher highs and record highs, and potentially what he thinks will happen from here. And then I'll wrap it all up with my little look at the technical charts. But first up, let's go to New Zealand, where I think it was overnight that we don't want to talk about the wonderful world of rugby. So what we will do is we'll talk about all things financial markets and the big picture on those. And we give a very, very big welcome to Julian. G'day, mate. How you doing?
Hi, Geoff. So many things to say. Yes, I believe it was the largest loss that Australia has ever suffered in rugby since possibly they invented fire. So
yeah,
there's
look, I must admit I had to turn it off. I couldn't take any more after 43 points.
They held on till half time, and then after that it was just the usual All Blacks performance in the second half. So and I do feel for you. It's been a crazy, some of the winter weather we've had this year has been absolutely crazy. I have sat there today and it's been a beautiful day, although somewhat chilly, but a beautiful day in Wellington, where I'm coming from today. So it's not from Auckland today, but it's from Wellington. So I'm on
windy Wellington. Well,
yes, I'm on the tail end of a business trip down here, and we're very excited to be here for the weekend. There's a huge amount to do in Wellington. It's an amazing party town, and we were accompanied by the weather, so it's been fantastic. Hey, look, guys, just to apart from actually thanking Anita for what I must say was a amazing rendition of West End Girls that was on the lead-in music. That was a cover version that was almost as good as the original. So thank you for that. Right, okay, so let's get started. I've just been through, for those of you that have missed it, I've just been through my macro overview. Well, hardly quick, it took about 45 minutes. I'm going to do a 5-minute version of that here. Ainslie, I'm going to apologise. I'm going to talk about gold, but not for very long, and hopefully it won't cover the stuff that you'll be talking about with gold, because there's something important happening there in that market that I think is worth mentioning. So guys, let's get straight into it. I'm just going to share my screen, and let's get going with this, and hopefully this will work, so just bear with me. Let's go. So listen, guys, here's when I talk about economics, this is economics 101. In order to have GDP in the economy, it is measured by consumption, which is the C word, and I, which is the which means investment, and then government spending. You can guess which letter that is, and then exports minus imports. I'm going to do the best thing that economists always do, which is to assume that export and imports are constant in this. So really, why am I doing that? Well, because I just want to point out something, right? So this year we have seen a significant amount of government deficits, right? So where does that money go? Because for the equation to equal a number, right, and the same number, if you like, as always, something odd has to happen, right? So if the government spends an awful lot more than it has in the past, then what is going to happen? Well, it means that investment has to be a lot higher. It also means that consumption has to be a lot higher. So yes, you can't buy your ute at the car dealer anymore, despite your best efforts, because there's quite a few people standing in front of you in the queue. The other thing means that investment is up. So what does that mean? It means flows into the economy is into the stock market is very high, way higher than usual. We've talked about inflows for the last 6 months being greater than the last 10 years combined in the US stock market. It's no surprise. And nobody should be surprised about that, because the government deficit is absolutely enormous. Why would you be surprised? Because when you look at this equation, it all sort of starts to make a bit of sense, right? So this is me making sense of the last 18 months, if there is any sense to be made of the last 18 months. So why am I putting this up? Well, not because I want to give you an economics lesson. It's because what I want to show you is when rate of change occurs, where is it going to change the fastest? So if the government starts to ease back on the amount of money it's going to use to support the economy, it doesn't take a genius to figure out that that C button and that C character and that I character in that formula are also going to have to adjust in a different way as well too. So what does this mean? Think about it this way. Government stops spending as much money as it had, not as much money will find its way into the stock market. So on the margin, does that mean that there are fewer or more buyers? It means there are fewer buyers of stock. So what does that mean? Well, in order for a market to go down, there can be the same number of sellers as there's always been. There just needs to be a few less buyers around for them to put their hands in their pockets, and all of a sudden you have a decline. So that is a potential break point for us to watch. So keep an eye on that, guys. Right, next thing I want to talk about. So I'm just going to flick through the things I talked about with the team earlier. Because we have so little time in my little section here, I want to talk to you about gold. I believe that we are getting close to the ending, the second leg, if you like, or the second wave of the bull market in gold. Now, what do I mean by that? I'm not talking about this next few weeks. This is a monthly chart that we're looking at here. Why is it interesting? Well, you can see that gold's done pretty well, right? 1200 to 1700 right now isn't a bad performance over the last 2 or 3 years, considering other investments, right? Especially seeing as it didn't go down that much in March of last year compared to other investments. However, it is not as good if you look at some of the commodities out there and what else is happening in the world. So what do I expect to happen next? Well, this is my roadmap for where I see the things unfolding as we go forward. This is not unreasonable, posted by a friend of mine on his website the other day. I don't think this is unreasonable. So we are in a secular upswing for gold. If you look at the 90 and 60-year cycles, haven't got time to unpick all of this. You just have to go with, right? You are looking at potential rally in gold of somewhere in the region of 400 to 500% as a minimum target. So what does that mean? It means gold goes from where it is now to $12,000. Yes, you heard it here, $12,000. But it's not going to happen by Thursday week. We're not talking about by September the 2nd, we're going to see $12,000. Maybe by September the 2nd, 2027, we may see $12,000. But what it's really saying is that over the course of the next few years, gold will continue to be an amazing investment. That's really the points that I wanted to try and get out of what's been going on. I've got one last thing I want to mention as well too. Hopefully, can see that from the charts, and here it is, right? So CPI, right? The CPI figures yet again came out pretty high in the US on Tuesday, Wednesday, I can't remember which day it was. We did CPI this week. Lots of inflation figures. Hey, and by the way, take a look at those ECRI leading indicators as well too. They were pretty worrying. They're seeing a cyclical turn down in those indicators, which is quite interesting. But what I wanted to highlight here is that when I talk about transitory inflation, this is what I'm talking about. So on the margin, right, the inflation increase was only 0.3% month on month, right? That's the key number, okay? That is not 5% or 6% year on year, okay? So that's way less than that. We're beginning to see this maybe transitory impact in inflation start to unwind already. So I thought it was going to take a little bit longer than this. We'll see what happens next. Next couple of weeks, months is going to be incredibly important for US inflation, but also bear in mind it appears to be just US inflation. This doesn't seem to be reflected too much in the rest of the world, not to the extent it is in the US. I'm not sure why that is, but just have to run with, right? So yeah, look, guys, I'm afraid that's all I have time for. Please look at my macro overview if you want to get any more details in this. So Helen's asking what kicks off a 60-year or 90-year cycle. Time is what kicks it off, Helen. You can go back, and we have the ability to go back and look at the gold price over hundreds of years. That's the way why they can come up with a 60 and a 90-year cycle. That's a pretty good reference point, I think, in terms of having some data. There's always other factors, Helen, for absolutely everything in the world, but why don't we just go with, from a cycle analysis wise, you're at a particularly crucial point. So yep, guys, that's enough for me, and thank you very much for listening to me, Geoff. That's me done.
Thank you, Jules. You don't escape that easily. You're in black, and I understand why you'd be in black. But the question from me is, when does, look at that, double black? That's worse. Well, it could be 10x, frankly.
Only in your mind is it worse, Geoff.
I know. Thank goodness I don't gamble or bet or invest in rugby games. That's the one thing I'm very happy about. But before I let you go, transitory, and you suggest that it's probably proving to be transitory, or that proof, if you like, is getting closer. What determines that? Where do we cross the line and say, okay, inflation is no longer a thing that we need to be concerned about?
Oh, I can tell you that right now. The Fed doesn't care. Okay, so the short answer about inflation right now is the Fed couldn't care less. The reason why I'm saying it's transitory is because underlying this market right now, there are some factors which is suggesting that that's exactly what it is. So what you're seeing is a slowdown in certain parts of the US and Europe, and also China as well too, that is suggesting that we're in a transitory point for inflation. Now, transitory means many things to many people, and the great thing about economics is I haven't got to explain it. I can just say it's transitory, which means it's not permanent. But what does that look like? Well, who knows? Right, and actually, I'm not sure the Fed's got any idea either, quite frankly. But it doesn't matter because they don't care. All they're interested in is the unemployment rate at the moment. That's their one key marker, and there's still loads of jobs to be needing to be created before the Fed will start thinking about doing anything aggressive, either in interest rates or on tapering. So we're a long way from a critical point. And I think what worries me is that if this is a transitory situation, and if you look at the Citibank Economic Surprise Index, I did have a slide of that, but I don't think I used it today. I'll see if I could find it actually. The Citibank Economic Surprise Index went below the break-even point today. So what does that mean? It means that we dropped below zero for the first time since March, April, May of 2020. That's not good. So what does the Citibank Economic Surprise Index mean? It means that the economy is now surprising to the downside in negative ways in the US, right? So when you look at all the different indicators coming out, the surprises are negative rather than being positive. So that suggests to me that things are slowing down, and yet again, the economists may be getting it wrong, and things are transitory in nature.
Interesting. Look, I know we can't go on because of time constraints, but I find that whole conversation extremely interesting, and the tipping point is the one that I'm really interested in. Mate, thank you. We can't go on, as I said, but much appreciated. Enjoy the bask in the bloody glory, and I can't even say
you get your chance in 2 or 3 weeks' time, right? There is the rugby, there is the Championship Cup left. I believe they're playing it somewhere strange. Where's the place in Australia that hasn't got COVID? Oh, hang on a second, Tasmania.
Hobart.
I'm surprised they're not playing it in Hobart at the moment, right? Because there's nowhere left in Australia that doesn't have COVID. You guys are just doing it tough at the moment, and my heart goes out to everybody in certainly in Eastern Australia with what you guys are going through. It's absolutely horrific, and I won't even bother to ask Ainslie what it's like of spending 54 days with 2 teenage girls, because I can't even conceptualize what that means. I suspect waterboarding may be an alternative option, which is slightly more pleasant. So I will.
Just awful. Not fun at all.
So there we are. And
the flippancy is out of place, I think. But anyway, we get the point. Thank you, Jules.
No worries, guys. Mate. Okay. I'll see you guys next week.